From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for October 18th, 2024. Let's check the calendar. This is the last weekend for Gallery Night this year. There's still one more week of China Lights at Burner Botanical Gardens. Your Green Bay Packers are hosting the Houston Texans this Sunday. And next Friday, your Milwaukee Bucks jumping up with the Chicago Bulls for the first home game of the regular season. Okay, let's start. In Indonesia, an Irishman is living a charmed life. He fell 650 feet down into an active volcano, landed on a 3-foot outcropping, and survived. All they got were a few deep cuts and severe bruising. Well, after being winched out of the active volcano, he tested his fate again. He lit up a cigarette. In Germany, a state-of-the-art fire station that was just finished last year at a cost of millions of euros burned to the ground. I bet they wish they bought some smoke alarms now. In Waterford, Ireland, the school children learned a hard life lesson. They were tracking and banding a flock of geese from Ireland to the Canadian Arctic and back. The Inuit are the indigenous people of the Canadian Arctic, and they get hungry too, and geese are mighty tasty. Do I need to go on? On the podcast today, we have Art Rothschild, Mike Helsel, Joel Driesang, and wrapping up the week, here's Kyle Teding.
Well, thanks, Max. A great week for markets. The Nasdaq up 0.8%, closing at 18,490. The S&P up 0.9%, closing at 58.65. And the Dow Jones Industrial average up a full percent this week, closing at the bell on Friday at 43,276. That's up 37 points for the day and 412 for the week. For the year, Nasdaq now up 23.9, the S&P up 24.3, and the Dow Jones Industrial average up 16.5%, all including dividends. That's a quick look at the weekend numbers. Art, maybe a good place to start. General optimism overall for stocks. We keep pushing up against new market highs. It's been more than a month now since we've had a 1% move on the S&P 500. On average, the last year, we've gotten one about every 5 days. So 20% of the time or so, we should see those big moves. And to go a full month, I think it tells you that maybe investors are seeing some more calm and that they've responded accordingly.
Yeah, what a wonderful week. And calm, or is it complacence? I think it really is calm. I think that's a better word for it. And it is earnings season. We talked about this a few weeks ago. Corporate profits have been coming out very nicely. The market has responded appropriately. I think Netflix, one of the most recent ones, came out with positive earnings or beat expectations, and so the stock went higher. A lot of excitement still over artificial intelligence. Of course, NVIDIA. Those earnings aren't going to come out, I think, for a few weeks. So this is people wanting to get in. What have they missed? I mean, it's been a great rally, as you're aware, over the past couple years. Being up as we are this year on the S&P, 24%. This year alone, we ended last year up 26%. Do the math. That's 50% within 2 years. But you're absolutely correct. There's a lack of volatility, which I think is lovely, quite frankly. But anyone who puts anything in the stock market at any time, be it individual stock or managed fund, has to be cognizant of the fact that over time, stocks do historically correct periodically. A 10% decline is nothing to be shocked about if it happens. 20% declines that people fear, bear markets, are very infrequent. We had one back in 22. This bull market could continue to run. So I'm thrilled, with what we're seeing out there.
Mike, maybe the biggest question I get is, okay, when's the next shoe going to drop? Because if things are as calm as they are now, and we're still seeing all of this writing out there on, hey, there are all these problems and no one seems to recognize them. Well, I think we all see them, and yet there's plenty of positive on the other side. It's not as if market rallies aren't full of problems historically. We go through all kinds of stretches. And so maybe a word on why it might be unwise to focus solely on the downside right now in a market in which, again, we've seen some pretty positive gains.
It is very interesting that, we've had, S&P is up 10 of 11 months, 9 of 10 weeks, 5 months in a row, and you still get people that are like, oh, but this, oh, but that. And then they come in and they ask me, well, why are you as optimistic as you are about stocks? Now, again, with the caveat is I'm not saying we should increase, your equity exposure or anything, but I think there's some room to run with this. And part of the reasons are you look at kind of where we are with this bull market. Again, we talked about it last week, 2-year anniversary or birthday, however you want to describe it. But we've had very little impact on the market from housing because rates. And not to say, again, that housing is like this big tent pole that's going to prop the markets up, but it's going to help, right? You're seeing more people take housing visits. So I think that's going to pick up, especially as rates come down. Rates coming down is the big piece of it. Inflation is trending downward. You could even say we're pretty close to where the Fed wants to be. That's a great point. Wages are higher than inflation, which means people's dollars go farther. The jobs numbers, again, jobs are slowing, but as we've talked about before, you can't do 300,000 jobs a month. That's just basic math, right? But if you're still getting positive job growth and people are working, and we've seen pretty decent consumer spending numbers, that's a pretty nice recipe for a good market for the next, coming up on 2025, maybe pushing into 25. And that market can kind of take on some of the challenges that are still there. They can take on some of those headwinds and kind of barrel through them, I guess, because things are, again, really solid and just on really solid ground right now.
Yeah, perhaps forgive the maybe vernacular here, but haters gonna hate, right? That if there's something out there that we can point to is, this is a downside to the current market, and there's, as I said, there's always plenty. Well, we're gonna point to those. The challenge is we can be right about the issue and wrong for a very long time about the direction of stocks. And Art, we've middle of earnings season now. You pointed out, I think, plenty of hype around any number of earnings out there that might cause investors to go, hey, here's that next great stock I want to buy because they're talking about all the things I want to talk about. I know you get questions from time to time of, hey, why don't we buy more of this or more of that? How do you kind of address those concerns?
That's an interesting question, my friend. If someone wants to buy something, I'm not going to stand in their way. It's very related to what Mike just talked about. It's tremendous. We are long-term optimistic about stocks. They're always going to go up, or they've always gone up over time. And that the same could be true of any individual stocks. But as I like to say, do you feel lucky? What we deal with is managed money. We put money in the hands of professionals who over time have proven that they can do well over long periods of time. We don't time the markets. We believe it's appropriate to have your money that's invested for the long term, invested for the long term. It's time in the markets, not timing the markets. And again, there's this old saying on Wall Street, buy when there's blood in the streets. Your better, odds of making money, are when the stock market is down. We've made plenty of money. We just, 50% up in 2 years. That's absolutely spectacular. But if things go down, the next trick is don't put all your money in the stock market. There's $7 trillion out there in money markets. And people say, oh, when's that going to come into the stock market? Maybe it won't. Maybe people are just being prudent. You keep your safe money safe. Keep what's in the stock market in the stock market. And again, as professionals, we don't know what's going to happen or when. We're not either optimistic or pessimistic. We can be optimistic with respect to making money over the long haul vis-a-vis stocks. We can, be truthful that stocks are, trading at records, very high multiples on average. That doesn't mean they can't go higher. So I think agnosticism is the best thing for us to be doing with respect to, where stocks are going in the short term.
I think you make a really good point because I think a lot of people assume there's still a fair amount of money in money markets and money market funds, and people assume that's just all going to go into stocks. I wouldn't count on that fully. I think a lot of people are still very happy to be earning over 4% plus on the yields, and I think a lot of people have balanced or rebalanced their portfolios where those money market funds are part of their fixed income bucket, right? So it might assume for a lot of people that those money market funds go into bond funds because, as Kyle has talked about before, depending on the sector of bonds you go into, there's some funds out there where you're still earning over 5%. So instead of going into the stock market, people might just shift their money market funds into bonds. So I wouldn't necessarily count on, as you said, money market funds driving up the stock market. I think it'll be something else besides that.
I know for our investors and the portfolios I look at day to day, they have plenty of exposure to stock. And so I think you're right, Mike, that cash isn't necessarily, in a lot of cases, it isn't necessarily money just sitting on the sidelines waiting to go to something cheap. More often it's, cash was the highest purpose, whether it was sitting in a treasury, a CD, or just in the money market earning a good yield. We might see some shift over time as rates come down, but I think you're spot on. That just doesn't mean, tomorrow it's in stocks because rates went from 4 3/4 down to 4 1/4. Joel, we've been talking a bit about earnings season, and in particular, one of the things that's come up over the last couple of years is this increased emphasis that CFOs, CEOs are placing on things like artificial intelligence in their earnings calls. You sent around a bit of a research piece from the St. Louis Federal Reserve talking about, maybe the implications of those conversations and just how much follow-through we're really seeing. Any big takeaways you have from kind of what the Fed had to say?
Yeah, the takeaway that I had from it was don't hold your breath. There's, as we often say with consumers, is, when they do surveys of how consumers feel about the economy, is, they say one thing and do another. They say that they're nervous about spending, and yet, we keep seeing them spend money. And in this case, some Federal Reserve researchers followed up. They saw all the comments that chief executives were making about artificial intelligence and how useful that would be, and implying that they would be, investing in that for their companies, but they aren't so far. But as you've pointed out, that could still come.
Yeah, it takes time, right? That capital expenditures, A, when rates are high, it's tougher to justify, but B, it takes some time sometimes to get the full company on board, the executive staff on board with how is this actually going to benefit the firm. I think what's interesting is, we have some parallels to history going back to, for example, the dot-com bubble, when a lot of companies just added .com to the name of their company, and all of a sudden returns followed on the stock until it was realized that, wait a minute, maybe pets.com isn't the best idea. I think you've got another parallel looking at, kind of the cryptocurrency bubble that happened, early 2020. As we all went home, you had a lot of businesses amid the start of the COVID pandemic that saw money chasing Bitcoin. And so you had blockchain being added to the name of a lot of businesses just as a way to attract investment, even though the end business was even very remotely tied to some of those things. And so I think there is that risk now that your consumer retailer or your brick and mortar retail shop decides to add AI to their name simply to generate some interest, but that they never really follow through on that. And I think when we kind of boil down, all right, is this a business or an industry or a trend that I'm interested in? I think it's one more reminder that maybe you got to tread a little more lightly. And it's
another reminder to think in the long term. I mean, not to just listen to somebody and hear them say something and then trust that that's going to, come to fruition right away. There's a maxim in journalism: if your mother tells you she loves you, check it out.
Who would your sources be on that?
Again, it just takes time and circumstances. Just don't take people at their word.
Art, we have some updates from, I think, the rest of the world that we haven't touched a bunch on in recent weeks. We've had a continued kind of pressure on China to increase some stimulus as their economy has slowed down. You're seeing slowing inflation in the Eurozone. Talk to me a little bit about maybe what kind of shift we have seen globally and how that might influence our investing going forward.
It's a great question, Kyle. You talk on a regular basis about how 2/3 of our economy this growth comes from consumer spending. And the good news here is that consumers are still spending. They're slowing down a little bit, but I like Mike's comment about lower interest rates. It's stimulating. It's giving more cheap money to builders who can build more, sell more houses to people. Retailers, I think they're lowering prices. This disinflation, I think, is happening. But in Europe, it's not the same story. When you look at the difference between, for example, Europe and China, they both have problems. China's trying to export cars to Europe. Europe's trying to export cars to China. Germany's, economic expansion is like dead in the water. They're the largest exporter in industrial company in Europe, and they're really flailing right now, and they're competing with China. And so Europe's putting on tariffs, on Chinese cars, and again, the same thing's happening, conversely. So there's going to be some weakness overseas, and that causes me some concern, a reduction in global trade. We seem to be a little insulated from that over here. That's a good thing. Interest rates have been lowered in Europe again. This week they're going to continue to be lowered. England's going to continue to lower their rates. China's continuing to try to stimulate their economy. But because their economy isn't built as well as ours, I don't think it's having the desired effect yet. They're not even sure what they're doing over there. So we've talked about this as well. Where are we going to invest? Well, there's opportunities overseas because they haven't done that well. There's more opportunities over here at the present time, I believe, because we're leading in things like artificial intelligence and spending. So the more we spend, the more we make, and I'm very optimistic. There was a report actually in the Wall Street Journal. They do a survey periodically, and they were talking about how much more optimistic the economists are than they were a year ago with respect to everything. Inflation, consumer spending, GDP. So we're in a pretty good place, according to the professionals, according to us as well. So I'm cautiously optimistic that we're in a better place than Europe and China, I can tell you that.
It's funny you bring up that survey, Art, because I saw the magazine, The Economist, today, who's, they're never very optimistic. They're not like perma bears or anything, but they're very conservative. They tamp things down. And their cover is the dollar in the shape of a rocket that says the U.S. economy is the envy of the world.
Wow.
So, if they're throwing that headline out there.
It's true.
Yeah.
Well, and I think we have gone through an extended period now of deglobalization, right? The pullback from this global economy to, hey, maybe let's pay a little more attention to our own backyard for a little while. That's not an issue for the U.S. that is largely insulated from global exports. We're mostly a self-sustaining economy with respect to our own growth, even if we depend on much of the rest of the world often for our own consumption. But if you're Germany, where nearly half of your gross domestic product is tied to exports, well, you're going to be far more impacted by the rest of the world saying, hey, maybe we're going to make it a little more expensive to buy your products than our own. And so I think, again, I'm pretty excited about some of the opportunities that exist outside the U.S. from a valuation perspective, from a potential dollar weakening perspective. I think the risk is precisely what you hit on, Art, which is that, hey, there's still a lot of problems out here too. And as long as we have to deal with a U.S. economy that looks far stronger, as long as that U.S. dollar is the rocket ship we all can pile onto, well, I'd still much rather put the vast majority of what I'm doing here in the U.S. Joel, not a terribly big week for economic news, but a couple of really, I think, important indicators. Top of my list is some updates on consumer spending. We had a retail sales number out late this week. Signs that the consumer remains strong.
Right, as Mike and Art both reminded us, the consumers are still spending in the U.S. The third month in a row, retail sales went up, and that's been going along pretty well. I looked, and this is not adjusted for inflation. Inflation figures into this because we're looking at revenue for retailers, but since the beginning of COVID, retail sales have gone up 35%. And then compared that to, this is why I looked at that number, was restaurants. Restaurants are up 59%. And that's one that's been steady lately is restaurants and bars. And people are still spending at those places. And that's, to me, always a good sign that the economy is going to be doing well because consumers are confident enough that they're going out. And I don't know about you all, but in some ways my family changed some of our habits during COVID. During the lockdown, we didn't eat out that much, and we decided to support local restaurants that we liked and just started to order out food more. And now we're more of in a habit of respecting and honoring those organizations and find ourselves eating out more.
I think that's certainly the case. We've spent, a couple of generations now transitioning from more consumption of goods to now consumption of services. And I think, restaurant bar service is certainly a part of that conversation that's only grown as we came through that pandemic and now have the ability not just to say, yeah, I'm going to order that pizza from the local pizza shop, but also, okay, maybe I'm going to go there and pick it up and grab a beer while I'm there as well. And so no surprise to me that that's growth we've continued to see. The reverse is maybe on the industrial production side, and we had numbers there this week that show maybe we're slowing a little bit there still.
That's right. It's showing that production is slowing. There were some odd things in there. The hurricanes, the two hurricanes that we've had recently, the strike at Boeing Aerospace Company, so that cut in on production somewhat. But it's showing that people aren't buying as many durable goods, which also came through in the retail numbers. Two of the sectors that didn't go up in September were furniture stores and appliance centers. So people aren't buying the hard goods as much anymore, but they're spending it more at bars and restaurants. And you can start seeing that in the industrial production numbers, which one of those numbers is looking at capacity utilization, how much of our capacity within manufacturing we're using. And we've been below the lifetime average of that number for 22 months in a row, which is a sign that inflation isn't. That inflation isn't something that's haunting us right away.
No, I think one more sign that maybe the inflation problem is, if not completely gone, certainly far closer. Maybe the last one on my list, some of the housing data. I struggle month to month with just what to make of some of this information. Sometimes it can be a bit volatile, but also, we talk at length about how rates impact the housing market. We talk at length about how much more, for example, single-family construction is needed. Maybe some signs that we have a little more of that construction going on, even as, broadly speaking, the housing market continues to show maybe some decline.
Yeah, we've been seeing trends downward in housing starts, so new houses beginning, and building permits, which is, you have to take out the permits before you start building the houses. So those are both been going downward recently, despite lower interest rates, although mortgage rates have gone up the last 3 weeks in a row. But you'd think that with lower interest rates that there would be more of this stuff. But the other number that I look at is a longer-term number, and that's the houses under construction. And that's been going down, too, since it peaked in mid-2022, around the time when the Fed started raising interest rates. And even though that's been going down, it's back to where it was, 7 months ago, 8 months ago, and that's the most it's been. I mean, it's historically high. It's near a 50-year high for houses under construction. And even those monthly numbers on housing starts and building permits, those are back down toward where they were just before the pandemic started, and which sounds maybe bad, but it's a level that we hadn't reached in more than a decade before that. So, relatively speaking, it's still in a pretty good position.
And a pretty happy place to be then for the economy.
There's another thing we haven't talked about too much lately is the unfortunate benefit of natural disasters. So they're going to mess up some of the statistics on unemployment or employment that we're going to be seeing because of people out of work due to these hurricanes. But after that, we're going to have higher construction, higher spending on appliances, new homes, building in those areas that were, devastated. So again, it's unfortunate. It's going to cause insurance premiums to go higher, but all the spending that these insurance companies and individuals are going to be doing is going to be good for the local economies. It'll come into the national figures too, I would think.
Yeah, it's such a tough conversation because there is so much devastation, so much destruction that to try to see some positive in it for all the wrong reasons it's okay. Yeah, there's some economic growth potential there, but still feel for the folks in Florida and Georgia and the Carolinas and all the other areas impacted. Maybe with that, we enjoy doing the program for you. We will talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk at landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.